Have you ever wondered why you keep losing money, even when your setup works perfectly fine on paper? It's not the market that's rigged against you, it's the person staring back in the mirror. Trading is essentially a game of probability, yet we treat it like a battlefield where we try to prove our ego right. Most traders ignore risk management because it feels like a cage. They want the freedom of the trade, not the constraints of the math. But here is the brutal truth: if you don't manage your risk, you aren't trading, you're gambling. And the house always wins when you gamble with your emotions. Let's talk about why we ignore the very thing that keeps us alive. We ignore risk management because we are wired for instant gratification. We want the win now. We want to see our account balance climb without the slow, boring process of protecting the downside. It's the thrill of the hunt that drives us, but it's the lack of discipline that leads to the slaughter. You see, when you ignore the rules of risk, you're essentially handing the market a blank check. You're telling the universe that you don't care about survival, only about the dopamine hit of a winning position. This is the first step toward failure. If you don't manage your risk, you have no business in the markets. Now, let's look at the most common trap: the error of increasing your position size after a loss. You've just hit a stop loss, and your ego is bruised. You feel the need to get it back. So, what do? You double your position. You think, I'll just make one good trade, and I'll be back in the green. This is the path to destruction. Increasing your size after a loss isn't strategy, it's revenge. You're trading from a place of fear and desperation, not from a place of logic. When you increase your size, you increase your stress. When your stress is high, your cognitive function drops. You become blind to the market's true movement. You're no longer watching the charts, you're watching the P&L, hoping for a miracle that rarely comes. Remember, the market doesn't owe you anything. A loss is just a cost of doing business. When you try to win it back with size, you turn a small, manageable cost into a catastrophic event. Never trade to get even. Trade to execute your plan. This brings us to the concept of emotional risk. We often think risk is just about the dollars lost. But the real risk is what happens to your mind after a bad trade. Emotional risk is the hidden tax on your account. It's the lingering anger, the frustration, and the doubt that clouds your judgment for the rest of the day. If you lose a trade and your heart rate spikes, you are under emotional risk. You are no longer objective. You've become a victim of your own biological survival mechanism. Your brain is trying to protect you from pain, but in trading, that protection is a death sentence. You need to detach your self-worth from your trades. A loss doesn't make you a bad trader, it just means the market moved in a direction you didn't anticipate. Emotional risk is the silent killer of accounts. Control your state, or you'll lose your capital. Now, consider this: how do traders go bust even when they have a high win rate? It's simple: they don't understand the asymmetry of risk. They might win 70% of the time, but the 30% they lose wipes out everything. This happens because they don't respect the math. They hold losers too long, hoping they'll turn around, while cutting winners too short because they're afraid to lose the profit. It's the classic human flaw of wanting to be right. We hate being wrong so much that we hold onto a dying trade until it's dead. If you don't have a defined exit strategy that you follow with military precision, your win rate doesn't matter. You are playing a losing game. The market will eventually find your weakest point and exploit it until you are empty. You can have a 90% win rate and still go broke if you don't manage your downside. Next, let's discuss the psychology of risk-reward. Most people look at a trade and see the potential profit. They dream about the car, the lifestyle, the freedom. They ignore the risk-reward ratio because they are blinded by the reward. But a professional trader looks at the risk first. They ask, what is the most I can lose here? If the risk is too high, they don't care how beautiful the setup looks. They walk away. A good risk-reward ratio is your safety net. It allows you to be wrong more often than you are right and still come out on top. It's the mathematical edge that separates the pros from the dreamers. Stop looking at the money you could make and start looking at the money you must protect. The reward will take care of itself if you manage the risk. Then there's the impact of the lot size on your mind. Have you noticed how your hands shake when the position size is too big? That's your nervous system reacting to the threat of loss. When you trade too large, you aren't trading the market, you're trading your fear. Your palms get sweaty, your breathing gets shallow, and your focus narrows to a single point. You lose the big picture. You start making micro decisions based on fear instead of macro decisions based on strategy. If your position size makes you uncomfortable, it's too big. Period. You should be able to watch your position go against you without losing your composure. If you can't, you're gambling. Your lot size should be a reflection of your confidence and your risk tolerance, not your greed. Keep it small, stay calm, and let the strategy play out. Now, how do you set a daily limit? This is the most powerful tool for self-preservation. A daily loss limit is your line in the sand. When you hit it, you stop. No more trades. No, just one more. No, I can fix this. You close the platform and walk away. Why? Because the market will be there tomorrow. But your capital might not be if you keep pushing. A daily limit acts as a circuit breaker. It stops the emotional spiral before it consumes your account. It forces you to accept the loss and live to fight another day. Most traders never set a daily limit, and that's why they blow up their accounts in a single session. Don't be that person. Protect your capital at all costs. This leads us to the concept of drawdown. Drawdown is inevitable. Every trader faces it. But there is a difference between a technical drawdown and an emotional one. A technical drawdown is just a dip in your equity curve. An emotional drawdown is when your confidence is shattered and you start questioning your entire system. This is the danger zone. When you are in an emotional drawdown, you start changing your strategy, you start overtrading, and you start losing your edge. You need to recognize when you're in an emotional slump. Take a break. Step back. Recalibrate your mind. Don't let a bad week turn into a life-altering disaster. A drawdown is just a test of your character. It's not a sign that you should quit, it's a sign that you need to sharpen your discipline. Now, let's talk about the danger of overconfidence. This is the trap that catches you right after a winning streak. You've had a great month, you feel like a genius, and you start thinking you can't lose. You increase your size, you skip your analysis, and you get sloppy. This is when the market humbles you. Overconfidence makes you ignore the warning signs. It makes you reckless. Remember, the market doesn't care about your winning streak. It doesn't know who you are. It only knows supply and demand. Stay humble. Every trade is a new opportunity to be disciplined, not a chance to show off. Finally, how do you survive a bad week? It's all about perspective. A bad week is not a failure, it's feedback. Analyze your trades. Did you follow your plan? Did you manage your risk? If you followed your plan and still lost, that's just the cost of doing business. If you broke your rules, that's where you need to improve. Don't beat yourself up. Use the data. Improve your process. Trading is a marathon, not a sprint. You don't need to win every day. You just need to survive long enough to win in the long run. If you can stay in the game, you will eventually find your consistency. But you have to be disciplined. You have to be patient. And above all, you have to be honest with yourself. Trading is the hardest way to make easy money. It requires a level of mental fortitude that most people never achieve. But if you are willing to do the work, if you are willing to face your demons and master your emotions, you can achieve something truly extraordinary. It starts with risk management. It starts with discipline. It starts with you. Keep your head down, keep your risk small, and keep your eyes on the long game. The market is a mirror of your own internal state. If you are chaotic, your trading will be chaotic. If you are disciplined, your trading will be disciplined. It's time to stop looking for the magic indicator and start looking for the magic within yourself. Master your psychology or the market will master you.